And, we have to make sure that we take measured steps to address any issues, because we're talking about safety and confidence factors, 99.9 to the, fifth and sixth decimal point. We have to make sure that what we do is as reliable and as safe as we've ever been. And to that extent, it's going to take time, and it's going to take people coming together to really chart out the future, not for a year or 2 or 3 years, but really making sure that we have a 5-10-year plan out into the future.
Separate question, which really goes to maybe Bill of Rights for customers in the U.S. versus Bill of Rights for customers in Europe. They differ meaningfully. And I'm curious how you actually think about that in terms of the benefits for consumers, the forcing mechanisms that some of those Bill of Rights in Europe may produce or not, as we're sort of seeing a lot of these types of issues play out, or at least problem issues play out for customers.
Hey, Andrew. So for us, it's really about running the most reliable airline that we can. We have to take care of our customers. We're reporting guidance here that's really positive. But you know what? The rest of the company is out taking care of another 5,500 flights today and a 500,000 customers. Taking care of customers is the first priority in terms of making sure that when disruptions happen, and the vast majority of disruptions, they happen for things like we saw, over the holidays when you had unprecedented storms. And there's always, maintenance issues that we have to account for as well. But on those types of things, when it's our responsibility and we don't recover the way we should, we owe the customers. And that's something that, we work with the administration on. I think that we have a program in place right now where we can take care of customers, but it's always incumbent on the airlines and here at American Airlines to do our best, because at the end of the day, that's how you build loyalty. At the end of the day, that's how you're more efficient. And I think it's better for the company overall to run a really solid airline where we're taking care of customers and addressing their needs.
Robert, thank you very much. Robert Isom, CEO of American Airlines. On a day, guys, look at the stock. It's up almost 5%. That's what happens when your guidance is essentially saying, we're going to give you double the EPS that we previously told you we would give you. Guys, send it back to you.
Did you have an important question, Andrew?
At some point, we'll have to get him back to talk about it, because it's just a slightly different issue in terms of there are regulations in Canada, Europe, and others that require certain amounts of money. And he may be acting in the best interest of both of what he thinks is the customer. But I'm just saying there are programs, and I think there's questions right now in this country about whether we should have different programs and what that does to the impact of pricing, by the way, just broadly. The price is higher, but it sounds like we'll have to do that conversation another time.
That's right. Absolutely. As people say so much. Thanks, Andrew. Thanks, Phil. Quick programming note. For tomorrow, Delta Airlines CEO Ed Bastian is going to join us following the release of quarterly results tomorrow at 7 a.m. Eastern Time. Coming up, something incredibly important, apparently. Some big financial names set to kick off earnings season tomorrow morning. J.P. Morgan, Citigroup, Wells Fargo, BlackRock, all on tap. We'll have a preview after the break.
America's biggest banks start reporting earnings tomorrow. We've got J.P. Morgan, Bank of America, Citi, and Wells Fargo kicking things off. Investors will be looking for the impact of rising rates and how lenders are preparing for a potential recession. Most of those stocks are up sharply over the last 3 months, with J.P. Morgan gaining 37%. Joining us right now with what to expect is Betsy Graseck. She is Morgan Stanley's global head of the banks and a diversified finance research. Betsy, we're heading into this expecting that the banks will start taking some decent-sized provisions to prepare for bad times ahead. What are you looking for from these four? What would stand out?
Hey, thanks so much for having me on, Becky. A couple of things. Number one is going to be, what is the asset sensitivity? What's the benefit of higher rates on the net interest income that the banks are looking for, not just, in the quarter, but going forward for the full year? And that is going to be on the positive side. On the negative side, we've got two things. One is outlook for expenses. We are anticipating that expense guides will have to move up above what consensus estimates are, anticipating right now today. And the second piece is, what about the loan losses? What about your provisions? We are anticipating that these banks are going to have to raise their reserve ratios yet again, given not only deterioration in the economy, but also in their own portfolios.
You lowered your price target in the last week or so for both Citigroup and for Goldman Sachs. Are there any of the banks that you expect to be standouts?
We are positive on a few names going into the quarter. That includes J.P. Morgan. One of the key reasons there is we're anticipating that they will show that they are more asset sensitive than the street expects, and that they will look to deliver positive operating leverage in 23, different from last year in 22. Wells Fargo, also an underappreciated asset sensitive bank. And then last, Northern Trust. Northern Trust is a trust bank with a history of not really telling you too much about what to expect. Their peers have already indicated deposit outflows are slowing. We think that'll end up being a positive for Northern as well.
So what is it that you don't like about Citi or Goldman Sachs?
On Citi, our expectation is that the expenses are going to be coming in a little bit higher than the street is currently anticipating. And as we look to this coming year, as they exit some of the consumer businesses, there's still a little bit of a tail of higher expenses for longer as they work down some of the costs associated with that business. As it relates to Goldman, look, the reason for bringing down the price target was a function of what we're expecting for market activity, as well as what the starting point is for earnings. And going through the fourth quarter, there were some haircuts we had to take to our own EPS outlooks for Goldman, and that's what's reflected in our base run rate, the liftoff point for 2023. And that's really where the price target reduction came in, not from the multiple as much as from what the expected earnings are likely to be in 23.
Betsy, thanks for the heads up.
Thanks, Becky. Appreciate it.